Capital market. Capital market is a market that relates to long-term funds, long-term securities. It is different from money market because in money market, short-term funds, short-term instruments are dealt with. So capital market is a market for long-term securities, long-term instruments, long-term funds, whereas money market is a market meant for short-term funds. Capital market comprises the infrastructure and institutional arrangement for borrowing and lending of medium-term and long-term funds. So there is no physical market as such. So it is a market that comprises infrastructure and institutional arrangements for borrowing and lending of medium-term and long-term funds. Capital market has two segments. So it is segregated into two parts. One of these is called gilt-edged market. So gilt-edged market basically is government securities market. It has instruments like treasury bills, like bonds, dated securities. And second segment is industrial securities market. So in this market there are corporate securities, securities issued by companies in the form of shares, bonds. As regards industrial securities, which is focus of this lecture, the industrial security market has two segments. So these segments are primary market and secondary market. Now, what is a primary market? So it is a setup where companies issue new shares, new securities. So they issue new shares, new debentures called new securities directly to investors. So in primary market, new securities are issued directly to the investors. These new shares, when issued, the method may be by way of a public issue, by way of a rights issue, or by way of private placement. There are two types of public issues. One, where companies and lead manager fix the price, and investors, if they want to invest in the company, they have to accept that price. The other method is where price is discovered by the investors themselves within a given range. So that method is called book building process. As regards the institutions which function in capital market, so these intermediaries are merchant bankers, issue houses, registrars, etc. So far as secondary market is concerned, it is a network for sale and purchase of securities after these are issued, after these are allotted through primary market to the investors. So through primary market, the securities, that is bonds, debentures, shares, these are allotted to investors called shareholders or debenture holders or bond holders. And then secondary market is the network where these can be sold or purchased. Now secondary market is represented by stock exchanges. In India, main stock exchanges are Bombay Stock Exchange, that is BSE, or National Stock Exchange called NSE. So these exchanges provide an organized marketplace for the investors where they can trade in securities. So they can sell and buy the securities. Market indices like Sensex and Nifty, these are used to measure the value of different securities as a group. So Sensex, it is a market index for Bombay Stock Exchange, and Nifty, it is a market index for National Stock Exchange. So these indices, they measure the valuation of different securities as a group. Now secondary market comprises the following. So it comprises, number one, the equity market, that is ordinary shares or preference shares, and other one is the debt market, it is bonds and debentures. Now secondary market, the major aim is to provide liquidity to the securities issued in the primary market. So secondary market provides liquidity to the securities. Now something about book building in a primary issue. What is meant by book building? We had just mentioned book building in the primary issue. So book building is a process to make an assessment of demand for a particular capital issue at various price levels. So the investors are to find the price. The investors shall bid at different prices to subscribe to the issue. In book building, the price of the share, it is not fixed by the company. Rather, the price is left to be decided by the investors. So the investors bid to purchase shares at prices quoted by them, and that price quote is within a range given by the company. So in the process of book building, the price is not fixed by the company, rather the price is decided by the investors who want to make investment. So those investors, they bid to purchase shares at different prices which they themselves quote. After application lodged by these investors, the lead managers or the book runner, they collect the orders and then decide the price to be fixed on the basis of quotations. So that is how this market functions. Thank you friends for watching this video. I hope you have been benefited by the contents. Thank you once again.